I'm Glavin Swain, and this is Reid, and we're doing our evaluation on McAfee. McAfee is a cybersecurity company that provides cybersecurity for personal computers and also computers for businesses.
And just a little bit of background on McAfee. It started off as a part of Intel and then branched out and was bought by a private equity firm. And just recently, they decided to go public. And here is kind of our valuation thoughts.
All right, so what we started off having to work with is the financial values from the income statement and the free cash flows from 2017, 2018, and 2019, and then the first half of 2020. So there's also a comparison of the first half of 2019 just for forecasting purposes. So what we did for revenue and cost of goods sold was to average out the growth in each of them from 2017 to 2018, and then 2018 to 2019, and then the first halves of 2019, 2020 to get an average value for the forecasting of 2020 to 2025 values. And once we got those, we subtracted the revenue and cost of goods sold to get gross profit. And we did a similar thing with the operating costs, averaging the changes from each of those years to get an average value for the 5 forecasted years. And then we subtracted the gross profit value from the operating cost values to get our EBITDA. And then the interest expense was a little bit more complicated because it varied a lot early on as they had different debt instruments. But for the forecasted years, there were only 2 super major debt instruments that were expensive in the interest category. And one of them expired in 2024, which was why it is $300 million the whole time from 2020 to 2024, and then goes down to $37.5 million in 2025. The foreign exchange gain loss rate is just an average of each of the years provided, and then using that for every one of the forecasted years. And once we got there, we added together the EBITDA in each of those 2 things to get the earnings before taxes. And then we used the 21% tax rate to go from earnings before taxes to our net income values for each of the forecasted years. Our working capital was provided as well in the filing statement by McAfee, and we used an average value for that as well to forecast for the next 5 years working capital. And then finally, we had the free cash flows from operations and change in working capital and then to investing. And they were all provided for the 2017 to half of 2020 period. And for operations, there were some big changes, as you can see, from the 27%, 55%, 200% from these 2017, 2018, and then 2018 to 2019. And then the 2 half-year changes values, because from the first half of 2019 to the first half of 2020, there was about 200% growth in free cash flow from operations. So our plan with that was to use a weighted average and weight 2017 to 2018 and 2018 to 2019 as 45%, and then the 2 half years average as 10%, because we were not sure when their cash flows to operations might come during the year, and that could be a factor in one of the years being way bigger than the other. And we thought the full year predictions would be more valuable when they were that inconsistent. And then using that weighted average, we got 57%, which we used until 2022. And then after 2022, we used 10% as the growth rate for free cash flow from operations to forecast, just because we thought the 10% rate is much more sustainable after the 60% for the couple of years after currently. And then we use the working capital values above to get the change in working capital for each of the years, and then provided our investing values from an average of the 2 half years, because there were some variance early on in 2018 with big investments made as the company gained traction as its own entity, as sponsored by the private equity firm, but then it balanced out a little bit more in 2019 and then the first half of 2020. So we used that for the entire forecasted period, the 57 million. And then finally, we could add each of those together to get the cash flow to invested capital for each of the years and each of the forecasted years. Next, we found the enterprise value using the present value at 7.67%, which is the weighted average cost of capital for the software industry. And then we subtracted the net debt to get the equity value of the company. And then one factor for us that we had to change was the controlling interest that was going to be public. And this company had only 22% that was actually going to be sold shares in the public offering. And what we did for that was multiply the equity value by the percentage, 22.4%, to get the public equity value. And then we divided the public equity value by the shares going public, which is 37 million, to get a share price of $33.25 on the income-based approach.
Awesome. So now we'll shift over to market-based approach and just touch on a few things here. So as you can see, we use 6 different comparables. Intel's one that we'd like to point out because that is the company that McAfee was a part of before they were bought by the private equity firm. We only weighed them at 10% though, because their market cap is obviously huge and they're just a big company overall. But we thought that was important to include here in our market-based approach. As far as the company that we gave the most weight, that's Trend Micro Inc., which is a cybersecurity competitor. It's a more similar market cap size to what we project McAfee will be. It's still a little bit bigger, but it also has a pretty reasonable PE ratio. So we did weight that one at 35%. Overall, we came up with a comparable PE ratio of about 40.7. So just kind of going to walk through our calculation there. We took our net income projections for the end of 2020 and adjusted that for the 22.4% controlling interest that'll be public. And then just took that 1389 and divided it by the shares that will be outstanding to the public, giving us a 38 cents earnings per share estimate. And then obviously multiplied that by our comparable PE ratio to get a stock price of 15.27. So finally, just kind of touch on our weighted share price. We did weight our market-based approach a little bit higher, mostly because our income-based approach, we had to make a lot of different projections, and our data history was kind of variable. A lot of times when you have a private equity firm that takes control of the company, they like to do a lot of different things with adding debt and things like that. So just makes it a little bit tougher to get reliable data there. So that is why we weighted our market-based approach at 60% and income-based at only 40%. But overall, it gave us a weighted share price of $22.47. So that's what we think about McAfee.
Thanks.